Welcome to Devins Distribution Company. On the left hand side I have the data, on the right hand side I have my spreadsheet. I've highlighted in the data the green items that are part of the balance sheet and the yellow items that are part of the income statement. So I'm going to dive into the income statement and I'm going to go through these numbers in order. Notice here that all of these are rounded off to the nearest thousand. Okay, starting with sales. 1.2 million orders during the year at 20 Rand an order, so multiply those two together to get the sales. So just note that this is 32,400,000 and we've rounded it. Okay, so cost of sales is the 1.6 million orders multiplied by 6.50 Rand. Get you a cost of sales. Sales minus cost of sales gets you GP. Let's go hunting for some expenses. So there's the sales and marketing, 2.5% of sales. General and admin, let's see where we find that. Maybe they gave us that number. That's always the challenge here, is to go hunting to find the numbers that you need. There's the general admin, 6.2 million. And the depreciation was given to us after depreciation of 4.34 million had been charged. So plug that number in. We've got those. Subtract them from the GP to get the operating profit. This number here, by the way, is the sum of these. The interest expense was 0, so these two will be the same. Taxation, they gave us a tax amount here of 25%. That's 25% of the profit before tax. And then some information about the dividend. And I can't remember where I read that or saw that. We've got to hunt around to find a dividend number. The dividend policy, there we go. The dividend policy was to pay out half their earnings after tax as a dividend. Alright, so that's 0.5 of that number. Okay, so there's the retained earnings. Let's take that number, let's head over to the balance sheet, add it to existing retained earnings to get the new retained earnings number. And there we go, the retained earnings from last year. You must add it to the existing to get this number, cumulative. Alright, next up, let's look for some ordinary shares. They told us here that they issued 20 million shares at a par value of 1 Rand each. Alright, so there's the ordinary shares and the retained earnings to get you total equity. There's no debt. Equity plus debt gets total capital. Let's fill that in. So total, no confusion about what that is. Take the total capital number, copy and paste it down there. Alright, fixed assets. The net book value of the fixed assets stood at 56.63 million. Plug that one in there. Stock values is what we are looking for next. There it is. We've got quite a low stock value because most of the stock belonged to Karoo.com. So that's 420. The debtors, we need to find a debtor days. The courier delivered quite strict payment terms. The debtor days amounted to an outstanding balance of, that's the creditors. Okay, well, since we've got that, we can put that one in there. That's the suppliers. We're looking for the debtors number. All sales are on credit. So that's important, so that we're using the full sales number. There we go. Karoo are slow payers at the end of the year, taking an average of 56.7 days to pay their accounts. Alright, so you're going to take the sales number, you're going to divide it by 365, and then you're going to multiply it by 56.7, and that will get you to the 5033. And they said there's no overdraft. So now we are solving for cash. And to solve for cash, we are going to use this formula. NA equals FA plus CA minus CL. Alright, so we've got the NA. There it is. We took it from the top here. We've got the fixed assets. We have got the current liabilities. The only missing piece in the formula is CA. So if we've got 3 of the 4, we can solve for CA. That will give you 17,873, and then you could subtract out the stock and the debtors and you'll get back to the cash number. All right. Cool. Let's move on to the next year. Pull up the income statement. They tell us here that transaction volumes increased by 30%. We're not prepared to put up the rate, so it will remain at 20 Rand per fulfillment. So that's great. You can take this number, you can multiply it by 1,3, 30% increase, and that works nicely. However, the cost of sales does change. So it's now rising to 7 Rand 50 from 6 Rand 50. It's gone up. So we've got 1.2 million transactions, which you've got to increase by 30% and then multiply it by the selling price. All right, so that will get you to that number of 15,795. Sales minus cost of sales gets you a GP. Let's go hunting for some expenses. All right, so there's an interest expense. All right, here we go. Marketing spend, 4% of sales. Admin costs, 4.2 million. That's great. Plug those in. Depreciation, that's going to go down to 2,770. Plug that in. Add them up. Subtract them from your GP. Interest paid, that was given to us. We had to, if we took on a loan, and we've got an interest expense. Let's see, where exactly is that? So there's the loan amount, and here 66.83 million is the interest expense. Plug that in. Subtract that to get your operating profit. Tax remained unchanged. Remind myself, what was the tax rate? 25%. No change in the tax rate. All right. Then subtract that to get the earnings after tax, and the dividend policy was unchanged. They paid half out as a dividend, and we have 4,065. Right, take that number to the balance sheet. Head on over here. Add it to your existing retained earnings. The ordinary share capital didn't change, but they did take on a long-term loan of 54,000. There's that number over there. Plug that in. Now we have debt plus equity. Gets you a total capital. Copy this number, plug it in down here. Let's go and calculate some fixed assets. This is a little bit of a tricky conversation. Sorry, tricky calculation. Got to think about this. So the warehouse would be purchased for an amount of 92,000. All right, help fund. So there's the loan that goes with that. But further on here, they tell us that the warehouse was not going to be depreciated at all. So the charge would be 2,077. 2770. Okay, we've dealt with the depreciation. Right, here's the data we need. DD would sell their IT infrastructure at the book value of 34.8, and outsourced service provider would charge them a flat fee of $1 per transaction. Okay, we've built the $1 into the cost of sales. So we got to do a little calculation here that goes as follows. We're going to take that number, we're going to subtract the 92, sorry, not subtract the 92, subtract 34,800, those are assets that we're selling, all right. Then we have to add in the assets that we're buying, all right, which is 92,123, all right, and then we must subtract the depreciation amount, which was 2,770 equals, hallelujah, that's a good result. There we go. That's how we got to the fixed assets. All right, so a reminder, what's going on here? Existing assets minus those that you sell plus those that you buy less the depreciation of your assets. Great. Stock number. There, they gave us the stock, 720. The debtors number, for the debtors number, we're using this 51,5 days, these payment days, and we've got to work that off the sales number. So go back, find some sales here, 42,120, divide that by 365 and multiply it by 51,5 in order to get a debtors number. Cash we're going to come back to. That's what they're wanting us to solve for. We've got no overdraft, and they said to us that the creditors would be exactly the same nominal value. All right, so we're solving for cash, the same as we did last time. So net assets, there's the number. Fixed assets is there. Current assets, we don't know what that is, but CL we do know. So we're going to solve for CA and then subtract out the stock and the debtors in order to find the cash. Great. Let's move on to the cash flow. Alright, so we start with operating profit. We come back here, we find this operating profit, and we must add back the depreciation. That's always the first thing to get the cash from operations. Then stock, debtors and creditors, we must go and get the differences and apply our working capital rules. So let's do that. Let's move these guys out of the way here. And simply say, what's happened to the stock? It's going up. If stock is going up, cash must be going down by the difference between the two. And in fact, I want to do this the other way around so that I get a negative sign there. Difference between the two. You can do the same calculation here. Difference between the two. And over here, well, the difference between the two is clearly going to be 0. All right, so we're going to take those numbers to the cash flow, plug them in, and you can do a little subtotal here if you want to. Normally I don't bother with that. Alright, so these are the transactions for working capital. Next up is investing activities. 2 transactions here. We sell the IT infrastructure, that's a cash in. We buy new warehouse, that's cash out, in and out. Alright. Increase in loan, cash in. Interest paid, cash out. Just got to go and find the numbers and plug them in. Dividends paid, cash out. Tax paid, cash out. These numbers here are all subtotals. Normally I don't bother with them. This is just a slightly older case that I haven't updated the formatting on. Alright, so cash flow for the year is the sum of all the transactions. Be careful, don't go and include the subtotals because you're going to get the wrong answer. Alright, then opening cash. You'll see this is actually cash minus overdraft, but because the overdraft is 0, it doesn't have any effect. It's the cash number, and now you can add these two together and you have the closing cash number. All right, so there are some questions that come on down here about analyze here the capital infrastructure. What is the capital structure of the company and effect on the borrowing so much money? So they have borrowed money, and therefore the capital structure is such that this debt to total capital ratio has gone from, let's enlarge this a fraction, debt to total capital, these numbers are measuring capital structure, from 0 to 40. Now generally, rule of thumb is if an operating business like this, I would say you don't want this debt to total capital to be more than 50%, but I also want to read it in conjunction with the interest cover. And this interest cover is really just measuring what is the proportion of the operating profit to the interest expense. Simply the one over the other. So what 2.6 says is the operating profit is 2.6 times higher than the interest expense. Obviously, the higher the interest cover, the more room there is to pay interest. All right, so if this number gets below 3, generally the banks are getting a little bit nervous. So you can look at these two in conjunction with each other. As you add more debt, generally the interest cover comes down. All right, so you want to kind of get this right in the sweet spot if you want. You don't normally want this to be less than 3, and you don't want that to be more than 50, there and thereabouts. But it does depend on the cost structures of the business. So I would say they don't want to be borrowing any more capital under these conditions. They're probably at their maximum. All right, examine the effect of the proposed changes on profitability. Well, this is quite interesting because what happens here at the operating profit level is they become more better off. It's more efficient to do this. All right, and part of that is because the depreciation expense comes down so much. All right, so the overall expenses come down, therefore the profitability goes up. However, but to achieve these efficiencies, they had to borrow money, and therefore the earnings after tax percentage is less because of the interest cost. All right, so it's always trade-offs. You get the efficiencies, but you have to pay for the efficiencies by borrowing money and using debt. So that's the impact on the profitability. Analyze and comment on the working capital. So what I'm noticing on the working capital is in both these cases, the stock and the debtors, is that the changes are such that they are reducing the cash on hand. All right, there's a negative effect on the cash flow. All right, and what you should try and do is, if you are having a negative effect on the cash flow in the stock and debtors, how can you gain back the cash in the creditors? In other words, trying to get this creditors numbers up. Because if creditors goes up, therefore your cash would go up. But in this case, their creditors number is unchanged. So they're not getting any benefit from cash flow in the creditors, while it is detrimental to them in the stock and debtors. All right. Analyze the cash position of the company and comment on the cash management in the coming year. So I just noticed that this cash position is very high. How do I know it's high? Well, I'm just simply saying that if their profit for the year is sort of 7 or 8 million, it's not quite double a year's profit, but it's certainly maybe 0.9% or 0.9 or 90% increase, or relative to their profitability. Let me be more specific. All right, if they make 8 million in profits here, and if you double that, you add about 16 million in cash. So they're not quite at 16 million, they're at 14. So they're a little bit less than double their profitability, and that is too much. So this is not working for them. It's a lazy balance sheet, too much cash. They could pay more dividends, maybe they could pay down some debt. They could make their balance sheet a little bit more efficient. All right, let's leave it there. That is the end of Devins distribution business.